Hi there, Stan, the Annuity Man, America's annuity agent licensed in all 50 states. Good question you just asked, which is, how do annuity payouts work? Hey, Stan, I thought all annuities were the same. Hey, Stan, this guy on television said I hate all annuities. Hey, Stan, my broker, advisor, master of the universe said never to look at annuities. Hating all annuities, grouping all annuities is like saying I hate all restaurants, I hate all trucks, I hate all socks, I hate all shoes, I hate all shirts. It's stupid. There's so many different types of annuities, but we're going to talk about the ones that create payouts, and then also kind of tell you some things that agents say that aren't true when it comes to payouts, but of course I'm going to do that. I'm the walking middle finger of annuity truth. And you know that, and you love that about me because you know you're going to get the brutal facts about this crazy topic called annuities because I'm Stan the Annuity Man. Nod your head, virtual high five, hit the music. All right, so how do annuity payouts work? Let's go through the three types, and then I'm going to dig in. I'm going to get the annuity shovel out and just, whatever. Anyway, I like the sound on that, whatever that is. Here they are. The three types are, you can peel off interest from say, like a fixed rate annuity, a MIGA. You can annuitize, and there's three specific lifetime income products that do annuitization. Think of annuitization. The way I explain it, my southern speak from the Carolinas is you have the water spigot in the back, in the house. If you rip the knob off the water spigot, water's just coming, you can't shut it off. When you annuitize and create a lifetime income stream, same thing, income's coming. It's just, you can't shut it off. It's over, it's coming. The only way to shut it off is to die. And by the way, that's not a good strategy. Just kidding. The third way is what's called income riders. Income riders are very popular since the 2008 time period when we had that little hiccup in the markets. Income riders have become very popular. They're not annuitization, meaning you're not ripping the knob off the water faucet and income's flowing and you can't stop it. Lifetime income is still the guarantee and it's still contractual, and as long as you're breathing with with income riders, but it's not annuitization. You still control the asset. So it's lifetime income, but you still control the asset. A lot of people like that. That doesn't make it better than annuitized products. It's just a different way to get to that lifetime income contractual guarantee. So there's only three. But let me bring up one that agents tout as income, and it's not. They'll say, well, if you buy this annuity, you can take out 10% penalty-free annually from the policy. That's not income, okay? That's not income. That's taking your own money out. That's like saying, well, you put your money in the bank and you take your money out of the bank, that's income. No, that's taking your money out of the bank. Same thing with when these sales pitches, like, I'll have people, I had a call the other day, goes, well, this guy pitched me an annuity, it's got 35% upfront bonus and I get to take 10% out per year. I'm like, stop, you're killing me. Number one, upfront bonus is candy for the stupid, don't be stupid. Number two, 10% free withdrawal is not, who cares? Great, you have liquidity, but it's only for liquidity if you need it. It's not a strategy. So let's get back to the three types of annuity payouts. Let's talk about the interest. Let me adjust my hat real quick. The interest, let's say you're buying multi-year guarantee annuities. Yes, you can go to my site and see the best live feed of the best fixed rates for your specific state, but it's like buying a CD, okay? Or if you own a bond, peeling off the coupon of a bond. Let's say you bought a 5-year multi-year guarantee annuity, fixed rate annuity, and it's 3 or 3.5%, whatever it is at the time of the taping. Hopefully it's higher if you're watching this down the road. You can just, with a lot of the carriers, you can just peel off that interest. Never touch the principal, peel off the interest. Sound familiar? Like a CD? Remember that? You can do that with the Jimmy Carter CD, remember that? Same thing, okay? You can peel off that interest, and that's, in some people's world, that's a payout. So, people say, well, I never want to touch the principal, but I want to know that the principal's there. I don't want to annuitize it. I don't want to turn it on for a lifetime income stream, but I want to peel off the interest as a form of a payout to me and the wife and the spouse or whoever. I'm like, perfect. Then buy a multi-year guarantee annuity and peel off the interest, okay? The second way for payouts, is what I was talking about, the annuitization products. Single premium immediate annuities, deferred income annuities, and another type of deferred income annuity called a qualified longevity annuity contract that can be used inside of your traditional IRA. So if you have someone go, never, ever, 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 ever buy an annuity inside of an IRA, never. They're stupid. and they're not informed. They need to read more and watch more Stan the Annuity Man videos, because QLACs were put on the planet for use with your traditional IRA, and the IRS and the Department of the Treasury were the ones that introduced it, not Stan the Annuity Man. When you hear stuff that sounds really stupid, when people comment about annuities and they're making this broad brush view, I hate all annuities. Never buy an annuity. Annuities are all expensive. Never put an annuity side of an IRA. Those people are dumb. And they need to stop talking. It'd be like me being a color commentator for ballerinas. It would make no sense at all. But annuitization products come down to when you need the income to start. I always ask two questions. What do you want the money to contractually do? When do you want those contractual guarantees to start? Let's take a couple examples. Let's just say income is the first answer. But the second answer determines what you're going to use as a product. If you say, I need income to start immediately or within 1 year, that's a single premium immediate annuity, period. We shop all carriers. Use my calculators on the site at theannuityman.com and see what the contractual guarantees are, and then contact us for customization quotes. If you say, I might need it like a year and a half from now, 2 years from now, 7 years from now, 5 years from now, whatever that is, that income later type thought, then that could be a deferred income annuity and a qualified longevity annuity contract. Just understand, the older you are, the higher the payment. Interest rates play a secondary pricing role, but once you turn on that income with SPIAs, DIAs, and QLACs, it's game on. It's income on, and you can't shut it off, period. Now, we can structure it so that when you die, 100% of any unused money goes to the beneficiary, so all the people out there, well, I'd never buy an annuitization product because when I die, the insurance company keeps the money. That's only one of about 40 ways to structure it, player, okay? So if you don't want that, if you say, I've worked hard for my money, I want the lifetime income stream, I want to transfer the risk to the annuity company, but when I die, when my Lyric jet hits the mountain, when my Dodge Ram truck hits the tree, I want whatever money's left in that account to go to my beneficiaries. We can do that even though the annuity company's on the hook to pay regardless of how long you're breathing. By the way, there's no ROI until you die because it's a transfer of risk. So those are the annuitization products from a payout mode. The third one, income riders. Income riders are very, very, very popular. Now, it's not a standalone product. You can't call it. It's funny, I did have a guy call me the other day. I've read all your books. I really like the income rider owner's manual, Stan. I just want to buy that. I don't want to attach it to any. I just want to buy the income rider. I'm like, you can't do that, player, okay? The income rider is attached at the time of application to either a indexed annuity at this time or a variable annuity. We don't sell variable annuities because you own an annuity for what it will do, not what it might do. I don't do variable. I don't do anything that can go down in value, okay? And the income riders attached to indexed annuities are traditionally and usually higher from a contractual guarantee standpoint than variable annuities. If you're just looking at contractual guarantees, not hypothetical, theoretical, projected, back-tested, unicorns chasing the butterflies returns that you hear, okay? Please, never make a decision on, well, if you'd owned it 10 years ago, Mr. Jones, you'd done this. That's crap, okay? If you'd have done 100 sit-ups a day for the last 10 years, you'd have six-pack abs, and you didn't do that. So look at it the same way. But income riders are good. It's income later. If you said to me, hey, Stan, I want income to start in 7 years, we're going to quote DIAs, we're going to quote income riders, and if it applies using your IRA, we'll quote QLACs. Income later, income at a future date, we're going to quote all carriers for those product types for the highest contractual guarantee. And then I'm going to tell you, one of my teammates is going to tell you, the limitations and the benefits, the good and the bad of each strategy. They're not too good to be true. They have limitations. Let's look at visually at income riders. Draw a line down a blank sheet of paper. That's me drawing a line down a blank sheet of paper. This side over here is the accumulation value, real money, the cash value, whether it's indexed option, call options, or variable annuity, depending on the income rider you're attaching. And over here is the income rider. It's a phantom account. It's monopoly money. And it grows at these really neat Jimmy Carter interest rates, and you go, wait a minute, Stan, this guy told me that I could get a 35% upfront bonus and 8% growth on the income rider. It's monopoly money, player. You can't peel off the interest, you can't cash it in, you can't transfer it, but you can use that side, this income rider side, to calculate your lifetime income at the time you turn on the income stream. Spoiler alert, this side here will always be lower than this side here 99.9% of the time. Okay, why does that happen, Stan? Good question. Because annuity companies have the big buildings for a reason, and in order for you to take advantage of that higher valuation on the income rider side, you have to turn on a lifetime income stream, which means the annuity company keeps the money as they're doling it back to you over your life expectancy. That's an income rider. Now, the other thing you need to keep in mind about income riders is once you have an income rider attached to a policy, it's tough to transfer it to another policy because you have to show during the application process, I have to show that where you're moving to is mathematically better than where you're coming from, and please do not let some grifter tell you, well, let's move it because you're going to get an upfront bonus. That is illegal, okay? That's crazy talk, and if you're an agent, listen to this, please don't do that. So we've gone over the 3 types of payouts: interest, peeling off interest like on a MIGA, annuitization, and income riders. And remember, ask yourself 2 questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? And then go to my site, theannuityman.com, and quote till your heart's content, run quotes. It's fantastic, and I'm going to pay for it. That's the philanthropist I am, the annuity philanthropist, CEO, write that down, annuity philanthropist. We need to trademark that because I'm giving, I'm giving. That's great. Listen, thanks so much for joining us. Hit the subscribe button, put in comments with no cuss words, please. Tell your friends and not friends, and I'll see you on the next Stan, the Annuity Man YouTube video.